Wanted to go through just our intros, disclaimers, stuff that we have to do. Quickly go over some of the deals that we have that are available. A couple of them are on the market, a couple of them are off market. But there's some stuff there that we've been working on, some opportunities for people that might want to flip a property, some multifamily stuff that we just put on the market, things along those lines. So I'll go through those fairly quickly. Not going to give you a lot of details, but if you are interested, I've got more information than what's on these slides. We'll be more than happy to share them out with the group and talk to you about it when we get through this. So we have the pleasure of speaking with Robynne Alexander tonight. She has mentored me / coached me / given me a slap on the back or on the ass, either way you want to look at it, over the last 2 or 3 years. Anything, she's done a lot in the real estate industry. I'll let her talk about her background, but any help that I need from a sales perspective to running a brokerage, property management company, just time management stuff, and then all the way up to these bigger deals where we're syndicating or raising money or things along those lines. She has a lot of experience in that, so I'm super excited to have her here and be able to pick her brain. Now I will turn everything over to you now, Robynne. I'm going to take a seat.
So the first thing I'm going to do, I have to do the disclaimers as well, guys. And thank you very much for letting me present. Before I speak, I always make sure that I do the disclaimers. This is for educational purposes only. This is an overview. It's not a deep dive into the subject matter. If you have any questions about a deep dive, just get in touch with me through Cody. I'm not an attorney. I'm not a tax advisor. I'm not a tax expert. I'm not a financial advisor. I do real estate, and I've done it for a very long time. It's always important for you guys to know to do your own due diligence. That means making sure you're looking into things appropriately. Anytime you invest, it is speculative and you can lose money. My goal every time I speak is to prevent loss through education. So that's kind of my disclaimer for all of this. We're going to talk about one of my favorite subjects, which is syndication. I'm going to pause on this slide for just a little bit. And the reason for that is because I want to give you kind of a well-rounded explanation of what syndication is. The very first thing to understand is you're probably going to be learning a new language, and syndication is just a fancy name for pooling money together. Okay. And there are syndications that require the Securities and Exchange Commission, and there are certain syndications that do not. And let me give you an illustration of them. So let's say Cody and I and a couple of you guys want to invest in one of the projects that Cody showed on the screen at the beginning. And let's say 4 of us get together and we all get onto the operating agreement, the LLC, and we're all going to be making the decisions on a monthly basis on what happens with this project. That is a syndication, but it is a syndication that does not require the SEC compliance and the SEC registration. And the reason for that is because all of us are pooling our money together. We have an expectation of profit, but no one individual member or no one operator is going to be making the decisions. We're all doing it as a group. Okay. So the reason why the Securities and Exchange Commission has to be involved when it's bigger than that, meaning bigger, it could be 3 people, 2 people investing with me and myself, except they just said, hey, Robynne, go out and find the project, you manage it, here's the money, deal with it. Okay. That is also a syndication, but that absolutely requires registration with the Securities and Exchange Commission. And this is something that a lot of people have started doing. They've started advertising on social media, etc. But you have to be super, super careful. Why do you need to be careful? Well, just because you don't know the rules doesn't mean that lets you off the hook if you do something wrong. Number 2, you are managing somebody else's money, and you need to manage it better than you manage your own money, because there's going to be people whose livelihoods and whose savings you can absolutely obliterate if you don't do this well. So it all comes from understanding how to invest in real estate, how to underwrite a project. Underwriting is just a fancy name for does it pencil, and poking holes in all of the assumptions to make sure that what you think you're buying is actually what you're buying and with the numbers that you're buying it in. There's two really popular types of syndication that are under the SEC umbrella. So from now on in this presentation, when I'm talking about syndication, I'm talking about syndication that is governed by the SEC, the Securities and Exchange Commission. So the two that I'm talking about fall under something called Rule D, and you have a 506B like Buddy, and you have a 506C like Charlie. Okay. And it's really important for you guys to understand which one you're going to be doing or which one you're investing in, because it has some very distinct characteristics that are different from one to the other. So if I'm a syndicator and I'm putting out an opportunity for people to invest with me, I better understand if it's a 506B or if it's a 506C. A 506B says that I can solicit this to people that I have a pre-existing relationship with. And that pre-existing relationship has to be more than somebody is a friend on my Facebook. Okay. You cannot advertise a syndication opportunity that is a 506B anywhere than directly to individuals whom you have a good relationship with. Okay. Think of it this way, 506B, you can solicit to your buddies. So that's an easy way to remember. 506C is anybody in the community, anybody in the country, anybody in the world. All right. And the difference, the subtle differences between a 506B and a 506C, aside from being able to advertise it, if I have a 506C, I can advertise it to anybody in the country or across the globe, and I don't have to have a pre-existing relationship. But they have to be something called an accredited investor, and we're going to talk about that in just a few minutes. And an accredited investor is somebody that can, according to the SEC, more readily weather the storm if there's a loss due to investing in real estate. Okay. 506B, you can have up to 35 what's known as sophisticated investors. And a sophisticated investor is somebody that simply says, okay, I can read this private placement memorandum, which is the vehicle that syndications go out as. Think of it like a great big sales brochure. So the sophisticated investor has to be able to say, I can read this document, I can understand this document, I've done real estate investing before, I understand there's a risk of loss, and I'm going to go ahead and self-identify as a sophisticated investor. Anybody, you can have up to 35 sophisticated investors. After 35, they must be accredited. Okay. All the syndications I've done have been very, very small. And they've been small for a reason, because these are syndications are a full-time job for one person just to manage the communications for this. All right. So that's kind of the overarching detail and description of syndication. So now that we have that, let's go on to the slides. And I'm going to bounce around just a little bit on the slides, but I'm going to give you some illustrations and some samples of what syndication might look like. Okay. So again, syndication is just being able to combine skills, resources, and capital to purchase and manage a property that otherwise you might not be able to afford all by yourself. But remember, you have to be able to understand how to read these documents in order to make an informed decision on whether you think it's a good deal or not. Okay. All right. So here's an example of a syndication where Mark finds a deal for $1 million. Okay. Mark would be considered the sponsor, the operator, the general partner. So there's a lot of names for the same words, okay? So a sponsor is typically somebody who is going to put together a deal and potentially even the one who puts together the syndication. So as the manager and the operator of the deal, Mark's going to put 5% equity into the deal, and then he's going to go raise equity, okay? And the equity, actually the 50,000 would be the down payment, and the equity would be the remaining 95% from investors, okay? Mark is responsible for managing the day-to-day operations of the deal. So that means this particular syndication needs to be governed by the Securities and Exchange Commission, right? Because one person or two people are making and managing all of the decisions. Okay. So there are different ways that you can split profits when you're looking at syndication. So the simplest is called a straight split. There's other ones that are called waterfalls, there's other ones that are accrued. There are a variety of different ones. We're going to give you examples of the most simple ones, and a straightforward split in this example would be Mark would be the gentleman who does the syndication, and he would be considered a Class A subscriber. Think of a subscriber like an investor, and the units that a subscriber gets is, you could analogize that to a share, okay? But in this world, in syndication, the vocabulary is different, okay? So if Mark is the syndicator and he goes out and gets 50 people to help fund the deal, those 50 people are considered limited partners. I like to think of limited partners as silent partners because they don't get a say in the management and the decision-making of the project. They only get a say of whether, oh, I like the terms of this agreement, so yep, I'm going to give him money and I'm going to invest, and this is hopefully going to be my return. Okay, so a straight split is like if we were to get everybody together and pool the money, it could be a 50-50 split, it could be a 60-40, it could be an 80-20. And when you look at that, here's what it would look like. So, oops, right there. Whoops, right here. So in the real estate syndication deal with an 80-20 split, the passive investor or the limited partner would get 80% of the returns, whether it was cash flow, whether it was profit from selling the building. Then it would be an 80% to shared among all of the investors, and it would be based on their percentage. So like if I invested $5,000 and somebody else invested $10,000, they would get twice as much of the profit as I would get because they put twice as much in. All right. And then the general partner, or Mark in this example, would get 20% for their role in syndicating the real estate. Let me also tell you one other thing with regard to syndication. There are typically 5 different ways that a syndicator or an operator could get paid. This is one of the ways. This is what they call the profit. So one of the ways they can get together is by something called an acquisition fee. And it's when they've put together the deal, they've negotiated the terms, they've gotten the financing put together, they've conducted the due diligence, they've done everything, raising the capital, et cetera. And that's typically going to be anywhere from 1 to 5% of the purchase price or of the raise of the capital. Okay. They also can get a refinance or a debt fee. So let's say Mark went out and he, got all the money that he needed to purchase the property, but we then needed to go out and raise more capital or get debt for doing renovations to a project. Okay. And then Mark goes out and he secures that debt. He can get reimbursed or paid for that effort of putting his name on the loan documents and becoming basically a guarantor for the syndication for that debt on that property. And so that's typically going to be 1% of the debt. So if it was $1 million, it would be 1% of $1 million or $1,000, or sorry, $10,000. Then he can also get paid by what's known as an exit fee. And an exit fee is when you sell the project. And it's recommended if you are a syndicator to not also be the broker who sells the deal at the end of the project, because it could be considered a conflict of interest. So that exit fee is typically going to be 1 to 3% of the sales price. He can also get paid a management fee, and that's typically going to be monthly, and it's typically some sort of flat fee of however much the syndicator knows it's going to take. So things like having a bookkeeper, an accountant, a tax person, a legal person for a particular syndication, right? That may run him $600 a month. So then he would be entitled to $600 a month so that he can go turn around and pay these bills. Okay. And then the final one is the profit. So it would be the final split of the profit when the deal is completely totaled out and the net profit is established. Then he could get his percentage of that profit. So it's really important to understand why a syndicator would do syndication, number one. And number two, how do they get paid? And all of those items, by the way, must be present in the PPM, the private placement memorandum. And that's just a really thick document. And it basically says things like, this is speculative. You can lose money. If you can't afford to lose the money, don't invest in this. And it can also, it also puts in there all of the operating agreement. It also says what the manager or what the sponsor is going to do. It says what the limited partner is going to get. And it also shows what the structure is going to be, whether it's going to be a straight split or if it's going to be a pref or it's going to be a waterfall. We're going to go into a couple of those examples here in a few minutes. So there's a lot of reasons why you want to read the PPM. And then the last reason you want to read the PPM is because it gives you all the specific details about the project, how much it's going to be purchased for, what the renovation is going to be, what the potential revenue is going to be. Is the revenue going to be paid quarterly, monthly, half yearly, every year? What's it going to be? Is there not going to be a payout at all until the project's completely done and stabilized, because it might be a ground up or it might be a really heavy construction renovation? So what is that going to look like? And then it's going to tell you what the potential projected profit is going to be and what your potential return will be if the operator does execute on the project the way he thinks he's going to, or the way he's specified it in the document. All right. So the purest structure for syndication is called a straight split. And that's where there's a percentage, 70-30, 20-80, 50-50, whatever it looks like. That's going to be identified in the PPM.
Robynne, quick question.
Sure.
On that, and there might not be a typical answer to this, but is that operator, are they typically expected to have a buy-in with those types of straight split deals, or are they usually getting paid just based off the work that they're doing on the project?
It really just depends. And it just depends on a variety of different things. And that's why it's critically important for you guys to read the PPM, because the PPM will specifically spell out in that circumstance what the structure is going to be.
Gotcha.
My structures are different if I'm doing a 506C than they are for a 506B. And they're different because I know the audience much differently in the B structure, because these are all my buddies. And
Right.
and the other ones I don't know these people at all. And so I tend to be a little bit different depending on what type of project I've put together, what type of syndication I've put together. Any other questions from anybody? Okay, we'll continue on. So we talked about the straight split. We're going to talk about the waterfall now, and that's where there's certain thresholds of performance that have to be hit before a different structure of return goes into place for the LPs, the limited partner, and the GP, the Class A, and the Class B, okay? So when you look at the waterfall, you're gonna see something called pref, which is a preferred return. So as an example, the last syndication that I did, we had an accrued pref because we knew it was going to be a multi-year project, and we knew that we were only going to be eating up cash and not spinning off any cash. So we said, if you put in $100,000, you're going to get an 8% return each 12 months that you're in there. So at the end of 12 months on their ledger, it would show $108,000. And then on the next year, it would show $116,000. So it would accrue based on whatever that agreed to preferred return is. And in a waterfall structure, in a cash flowing project, that 8% pref is going to be handled a little bit differently, because it says if we're making a profit and that profit is 6%, only 6% will go to the limited partners and nothing will go to the general partner, because we haven't met that threshold of performance of an 8% return. But if we went up and it hit 12%, then the limited partners, the syndicate, the subscribers in the syndication, they will get all of that 8% split amongst themselves. And then the next 4% above that 8% threshold will be split according to whatever split was indicated, 80-20, 50-50, whatever it is, okay? So here's an example of the 8%, where I just basically described all of this to you guys. So the investors get 100% of the first 8%, and then if we go above and beyond that, Mark will get, in this example, Mark will get more, okay? But he has to hit that 8% performance before he ever sees a dime of profit, okay? So here's an example preferred return. See, we all use 100,000 because it's just easy math. So in the first year, they would split $8,000. Okay. If we only raised, so this is just if an individual did, right? Same thing, 108,000 would be their profit at the end of the year. Okay. And Mark, the general partner, doesn't get any of that in this example because the pref was 8%. All right. Earlier, I said if we only hit 6% on that threshold, doesn't mean we're going to get that 8%. And that's what this slide is saying. This is saying that you may have a pref return, but you might not even hit that pref return, especially if you're getting ready to stabilize something that's new to the market, right? Maybe the first month it's a 3% return, maybe the next month it's 6%, the next month after that it's 9%. Well, once it hits that 9%, 8% gets split among all of the subscribers, and that 1% gets split according to whatever the full split was between Mark and the subscribers. Okay, so that gives Mark incentive to go out there and make sure that these returns are as high as possible, because when you look at a waterfall structure, and there's many, many different ways, and some of them are super complicated. I'm going to tell you, if you ever read a PPM that is super complicated with the returns, just be careful, because it's a way to mask how much the general partner is actually going to get, because the better the property does, the more money Mark is going to get and the less money the investors are going to get. So I like to keep things super simple, because if in my world, if it's simple, I'll do it. If it's not simple and I can't explain it, then I'm not going to do it because I don't understand it well enough. All right. So we talked about this. Once you go above that 8% return, if you had an 8% pref down here and we actually achieved 14%, then the 8%, 100% goes to the investors to split. And then the remaining 6% gets split 70-30 in this example, 70% to the subscribers investors and 30% to Mark. Okay, so we're trying to make it kind of simple visually to be able to see it. And then when you start looking at waterfall structures that have these different threshold points in there, it really can get squirrely. I would highly recommend you stay away from subscriptions like that, because they are very difficult to actually project out how much your return is going to be. And the more complicated a PPM is, the more likely there's something going on behind the scenes that is going to allow the syndicator to get way more money without technically disclosing it. Because if you can't do the math to figure it out, it's going to be not as desirable, in my opinion. We already talked about this. Mark is incentivized to do better, because the better he does, the more money he gets. Okay. So syndication is typically structured as an LLC and the LPs. So the LLC will take title to the property. And because the LLC takes title to the property, if you're investing in a syndication, it is not generally eligible for a 1031 exchange. It's not compatible with a 1031 exchange. So if you've sold a project and you don't want to pay capital gains on it, ordinarily you would roll that into another investment property. But in this case, you're buying, you're subscribing to units in a company rather than in the real property. So the company is the LLC that takes title to the property, and you become a subscriber in that entity. Okay. And the sponsor participates as the general partner or the manager, and the investors are the limited partners, passive income subscribers, or more accurately called subscribers.
So were you saying, Robynne, that based on a syndication, like, would everyone have to agree to do a 1031 if with the,
Nope.
or can you
Not eligible.
You just can't do one at all?
Nope. In 99.9% of the cases, they're ineligible for a 1031 exchange.
Gotcha.
I'm going to recommend that you speak with an extremely good tax attorney that can help you understand that.
Sure.
Okay. Like I said, I'm not a tax specialist. I'm not an attorney, but I'm going to tell you there are rare exceptions that you can do a syndication and a 1031 can potentially apply. So as an example, you guys may have heard of the opportunity zones, and this was a way for the government and collectively with all the governors of all the different states to identify areas that need some urban development and they need some cash infusion, et cetera. So there is a syndication called an opportunity zone fund that you can take any capital gains event, whether you sold Bitcoin, whether you sold stocks, whether you sold real estate, a luxury yacht, whatever capital gains event you have, you can roll that into an opportunity zone fund, which is a syndication. And it has completely different rules than the Rule D and the 506 series. Okay. So I'm going to tell you, generically speaking, what you guys are going to see out there with a PPM will be ineligible and incompatible with the 1031 exchange.
Hey, we have one more group member with a question real quick.
Sure.
So if you have to set up the LLC, then does that mean you'll get K1s annually? And the K1, the percentage will be your percent ownership, I guess, is same percentage, your percent partnership in the syndication?
Yeah, so the K1s look a lot like a W-2 that you get at the end of the year for filing your taxes. And it will show, it won't necessarily show what your percentage ownership is, but it will say your subscription, your unit value is worth $327,000, right? Whereas last year it might have been worth $298,000. So when you file this K1 with your taxes, they will know how much to charge you for that amount. Now, remember I had mentioned that if I have a big construction project and it goes multiple years, we do not issue K1s on an accrued interest basis. And the reason for that is remember I said if they invested 100,000 at the end of 12 months, their ledger will show 108,000, and at the end of 2 years, it would show 116,000. Well, if I gave them a K1 in year 2, it will show that they earned $16,000 from interest, but they haven't actually received that money. And so it becomes phantom income. And because it becomes phantom income, and because this is a long-term construction project, we don't issue K1s until we start cash flowing. And that way it catches everything up at that point. But again, if you do a syndication, make sure you check with your attorneys, make sure you check with your tax advisors to make sure you're doing the right thing for your project. Okay?
I have one more question
So,
while we're here, Robin.
of course, of course.
So, we've done a few deals where we have multiple partners in an LLC on a larger property, and they've obviously structured with an operating agreement. Is there some sort of, with the 503B and the 503C, is there some sort of designation that you need to make, like with the SEC or at tax time, or like how do you, with your attorney, measure that, whether it's a 503B or a 503C, or is it just, I'm not sure how that's like gauged or how it's tracked, I guess, is the question. Like, is there a separate document that you need to fill out as a 503B or a 503C when you're making your LLC documents? All right, are you back?
I'm back.
Okay, sorry, we cut out there. I thought maybe
Oh.
my question was inadequate. You froze quick on us.
Oh, sorry about that.
Did you hear my question by chance?
I thought the question was, why don't you repeat it?
We've had a couple investments where we've had like a larger property, and we've had 3 or 4 partners or investors in an LLC, and we had our operating agreement set up and everything along those lines. But I was curious, like, is it at the beginning of that process that do you have to file as a 503B or a 503C, or does that come at tax time? Or how do you like designate yourself with the syndication on like which one of those you are?
So think of the LLC and the PPM as 2 separate documents, okay? The LLC is, I've got an operating agreement that's going to set forth all of the terms by which the partners for the LLC are going to operate and interact, okay? And you can go out and buy buildings and whatever you want with the LLC, okay? And you may or may not need SEC registration for that LLC. It's just depending on how it's structured, right? So I would recommend you speak to a syndication attorney or a business attorney that knows about syndication so they can advise you appropriately. The PPM references this LLC, but it also references who's going to be the manager, what their responsibilities are. So it's a different document than the LLC per se, but the LLC can stand by itself without having a PPM. But a PPM cannot stand by itself without having an LLC for the projects that it's going to be applying to. I don't know if that helps you on that.
Yeah, go ahead.
Robyn, would that be then similar to just a joint venture agreement?
Yeah, the LLC could very well be reflective of a JV. Yep.
But
Or even a co-GP agreement, like a co-general partner.
then like in Cody's instance where, you got, a handful of guys that go in, where does the point come that you have to register with the SEC and become considered syndicated?
So after you've set up your LLC, if after you've set up your LLC, you decide you want to do a syndication, At that point, you create a PPM that references back to the LLC,
But
right?
that's, when you get the SEC involved, that's only with, people that you're not familiar with within a group, right? That's when
Nope.
you're.
Nope, if you do a Rule D, 506B or a 506C, you have to register your PPM and the syndication with the SEC. Okay, but if all you're doing is getting, three buddies together and you're all gonna pool your money together and you're gonna operate this LLC, you don't necessarily need to register a syndication. Okay, but in yours, if you're trying to pull together a bunch of people and circumvent the SEC requirement, that's going to be a slippery slope for you. So I'm just going to say that if it's just a couple of you guys wanting to get together and do $1 million project, that's great. But just make sure you understand that if there's only one person making the decisions and managing the project, like if you have 4 people in there and 2 of them are making decisions and managing the project and stuff like that, technically you need an SEC registration.
So the biggest thing is really just, is there one managing member or is there more than one manager?
Well, I mean, if you've got 8 people and you're all having meetings once a month and you're all collectively voting and making decisions, then that is a syndication, but it doesn't require necessarily the SEC oversight. Okay, but if you've got 4 people in there and only one person is managing it and there's an expectation of profit, you definitely have an SEC registration issue. Okay. Sorry, my phone just buzzed. What was that question?
I was just saying, I wish my attorney was here, who was here last month, because we probably need to have a little chat.
Yeah, probably. Like, anytime somebody has a specific question that borders on, a tax or a legal question, I definitely refer them back to their stable of experts, because every situation is going to be different. So here's just a graphic for you that shows the limited liability with the members and the managing member, and then the limited partnership with the general sponsor and the limited partners, right? So these look very similar, and they are similar. This one on the left may or may not. Well, if it's a managing member, it definitely has the potential to need that SEC oversight. Whereas over here on the limited partnership, right, you've got your sponsor, you've got your general partner, and then you've got all your LPs over here. This definitely requires SEC registration. Okay. So what was that?
I just have a question for Cody. So your deal in Radford, is that considered a syndication?
Well, if you go back one, Radford, if you go back one, Robynne. So the one that we did in Radford was very similar to the one that left, where we had an operating agreement. We each put pretty much equal amounts of capital into the deal. Like, I was considered the managing member because I'm gonna, show the properties, like do the construction, make sure the financing is in place. But everyone else is members with, like, they have some say in what's done and what decisions are made. But it seems
See, that's the distinction right there, Cody, is that they have input and decision-making authority for that project. And you as the manager, might be the one who can ultimately sign on the dotted line for the decisions that are made. But if they are involved in the decision-making, that is not necessarily something requiring an SEC. The one on the right-hand side, the limited partner, remember I said limited partner, think of them as a silent partner. That means they're not involved in the decision-making at all, and that definitely requires SEC.
Yeah, that's a good distinction right there. You have a question?
So basically, the whole reason for reporting to the SEC is so that the silent partners or investors don't get screwed by the sponsor.
Pretty much. Yeah, I mean, I'm sure that there's a fancy legal, more diplomatic way to say it, but when you cut to the chase, yeah, it's so that the SEC can protect the subscribers.
Sorry. That's the one.
What was that?
We're gonna run with the term screwed and we'll put that in the.
Sorry about that.
I'm good with that. That's a good technical term. So remember I told you that both 506B and 506C can accept accredited investors. 506B, your buddies, you can have up to 35 self-identified sophisticated investors. On the 506C, the community, the country, they must be accredited. And I would always have you check on the SEC website to get any of the updated statistics on this. But by and large, you have to have a net worth of at least $1 million, not including your primary residence. And that's either individually or jointly. If you're married, you have to have a combined income of at least $300,000 for the last 2 years, with an expectation that you will continue in that income bracket for the foreseeable future. And then you have to have an income of at least $200,000 for each of the last 2 years, with a fair certainty that you're going to continue on that if you're single. Okay. There are other things, but these are the 3 main bullets on what makes somebody an accredited investor. To verify this, so there's 2 really popular ways. One is to get a letter from the subscriber's accountant that says they are, either from their bank or from their accountant, that says they are an accredited investor. The other one, and this is the one I use, is I use a third-party site that validates the information, because that way it's independent and somebody's not going to be able to fudge with the numbers. So that's what I use, but you can get away with, a bank letter that says, yep, I have $1 million in the bank, or, a letter from the CPA. I did their taxes and their taxes were $350,000 for the last 4 years, as an example. So that's pretty much it in a nutshell. Remember, this was an overview. This was not an in-depth deep dive. As you can see, there are a lot of moving parts. There's a lot of nuances, and it's really important that you guys understand that if you're going to do syndication, become well-versed on it first, because it's not just your investors that you're protecting, you're also protecting your own bacon.
So I think we got a few questions.
Okay, sure.
So let's say you're poor, you don't meet the income qualifications. If you wanted to get started into investment property, though, you could buddy up with let's say 4 other guys, be an equal partner, be making decisions together, and all invest equal amount, and that's how you can get started into it.
Yes, generically speaking, yes. But again, I'm going to tell you, for your specific situation, check with an attorney to make sure that you're not violating something inadvertently.
Well, and there's some situations too where you can, and correct me if I'm wrong, but in these like 503Bs, the buddy transactions, you can kind of trade time and effort for some equity as well, right? So it's not always like equal buy-in with capital. It could be based on what are you doing with the project, what parts are you managing, what are your responsibilities, and you might be able to gain some equity that way if it's not always capital.
Yeah, you could potentially do that in a syndication. I think you would have to specify that as one of the ways an investor gets subscribed, if you will. I think it would be cleaner if you were to have that person come in as a member of the LLC rather than as a subscriber to the syndication.
They could potentially put a dollar amount on the work provided to.
Correct.
Yeah.
Yep.
So I had more just a I guess a general question on syndications. You know, as far as like the sponsor or somebody doing one of these big deals, what's the typical way, or like what you've seen as the best way? Like, you know, when you're talking about having up to 35 subscribers, like that's quite that's a good amount of people. There's a lot of moving parts there.
Well, let me make a clarification there, because in a 506B,
Yeah.
right, with just your buddies, you can have up to 35 sophisticated investors. If you go to a 36th investor, they must be accredited. So like on my my last 506B, I think I had 4 that were sophisticated and the other 8 or 9 were accredited.
So I guess what my question was, what I was getting at is, you know, when you start to get into these bigger pools of people, it's not just 3 or 4 buddies, you know, doing a deal. What is the syndicator like? What systems do they need to have in place? What type of, like, you know, is there, you know, for people like yourself, where we say, hey, we have this deal, but you know, I've put it together, but I'm not able to take this and manage all 35 investors and the legality of it and the paperwork and the taxes, like how do you kind of set that up as a syndicator versus just being like the sponsor or the operator of the deal?
Yeah, so before 2016, you weren't able to solicit online. And now that the SEC says you can solicit online, there are a lot of platforms out there, software companies that will make your life so much easier. And there's a lot of different ones, so don't ask me which one I use because I've tried multiple ones. Just know that there are platforms, so you pay monthly, sometimes you pay annually, it just depends on the program. You have to make sure that they have full encryption and things like that, because what ultimately winds up happening is the entire PPM goes onto the website. And then if a subscriber, if an investor says, "Ooh, I think I want to subscribe," they push a button, they create an account, and it becomes a secure account, and then they can link their bank account information with the syndication in order to be able to make their investment, and then to get their returns and things like that. They also in these platforms, they also have an email portal. They have an upload portal, so you can upload the K1s there, and then 24/7 the investor can go pick up their K1s. They can also check to see any progress that's been made on the project, anything that you guys upload for Excel spreadsheets and things like that for being able to show construction and stuff. So there's a lot of different ones out there. Prior to that, prior to 2016, before these internet software portals came into play, it was a bear, and I did it with Excel spreadsheets, which was not an easy task.
Part of the management, right? That's
Yeah.
Where you're like, and this is part of why I'm taking a fee as a syndicator, is having all this, make sure that things.
Correct. And that particular fee would be nested inside the management fee. Remember I said there's 5 different ways syndicators can get paid. One of them is a monthly management fee. So make sure you understand all the tools and all the resources that you're going to need so that you can put the appropriate amount in the PPM for what that monthly management fee is.
So I have one last question, Robynne. Do you mind describing the difference between like setting up a syndication and setting up a fund?
I'm not sure I understand the difference.
So I guess like I've heard syndications being more specific to like a certain deal, like you're pulling
okay.
money for a specific deal, whereas a fund, you would pull money together, but say it's for this general purpose.
Yep,
And
yep.
Once it's-
So, yeah, so one is just called a syndication, and it's a specific for a specific project, 123 Main Street. If you know you want to get investors and you know you want to go out there and invest in properties, but you don't know what the name of the property is yet or the address, that's called a blind pool. And that's where everybody's putting money in together. This is what your expected returns are going to be based on past performance, et cetera. So there is no property address. It could just be apartment complexes that have at least 20 doors, that is underperforming by 25%, that is located in the general Nashville market, that type of thing. You can detail it out that way, and it's called a blind pool. And then there's something called a fund of funds. And the fund of funds is, I'm a syndicator, but I don't have a project, and I've created, I've raised $10 million worth of capital, but I don't have a project to invest in. You go to another syndicator who has funds, and then your fund becomes a subscriber individually into that fund. Okay. And so whatever the returns that your percentage has invested into that fund you'll have to distill that down into the returns for your subscriber. So your subscriber becomes, a pool of money, but you are the syndicator, which now becomes a subscriber in somebody else's syndication.
Interesting.
Guys, I could talk to you for like a week and still not exhaust this topic. There is a lot of stuff to learn in here, and this is just the high level, scratch the surface to give you an idea, so that when somebody says, hey, I have a PPM, all of a sudden you go, oh, PPM, oh, that's a syndication.
Right. That makes sense. Anybody else have any questions while we got Robynne? Robynne, what's the best way for them to, to follow you, or, obviously, coached me over the years. If anybody has any ways to get in touch with you, or best ways to reach you, what would be those?
Yeah, you can always find me on Facebook. I'm pretty easy. You see the spelling of my name there. That's the biggest challenge, is spelling my first name properly. You could send me a text message. Cody, you can share my my numbers with the guys if they're interested in it. Shoot me an email.
You do any consulting work? So like, let's say we had a big deal and we were like, hey, we've got the money, but we don't know how to set this up.
Yeah, I do a lot. I do a lot of consulting. Yeah.
Perfect.
Yep.
Please.
I also do coaching and mentorship, and that's usually individually. I'm looking right now at doing group coaching. It's just a bigger bang for my time. So that may I think if I do that, I'll probably do it like every other Saturday at 9 or noon East Coast time.
Okay. That's good to know.
I haven't quite set that up yet, but up till now, it's just been one-on-one. And Cody can tell you, I one of the things that I do particularly well, I've been told, is to take these really difficult concepts and distill them down into easy to understand chunks. And like he said at the beginning, whether you've got a brokerage and you need help with that, or you're trying to figure out how to get into business, or you're trying to figure out wealth building, or, passive income. Yeah, I've done this for a long time. I did my first fix and flip back in 1993. I've done over 100 projects. The newest project I'm getting ready to close on is going to be a ground up 1,260 residential units with 86,000 square feet of retail, 30,000 square feet of commercial, two towers of hotels of 200 rooms, senior care, assisted care, whole bunch of stuff on 217 acres. So it's a really big one. It's a $740 million build. And if I knew then what I know now, I would never have done single family fix and flips.
Yeah, we've kind of had those growing pains here as well. We were all like raising our eyebrows at a $30 million deal we were talking about last month. So here in 750 is like, All right.
Yeah, I've learned that the fundamentals are the same, the underwriting is the same, and as long as you know how to, as long as you learn how to do the fundamentals using nothing more than a calculator, a paper and pen, you will eventually be able to read any PPM and really understand it. But those people that look at PPMs and they're like, oh, this sounds like a really good idea, but they have no idea what the PPM is telling them, they're gonna get bit in the butt. There was this one project, one of my students said, hey, Robynne, can you help me read through this PPM and tell me if it's a good deal or not a good deal? And I said, sure. So the place where this was being bought, I'm not going to go into all the details, but the normal cap rate when they were projecting 4 to 5 years out in a healthy market should have been around 6%, and they were buying it in a very compressed cap rate of 2%. But when they ran all of their numbers and their projections, they were buying super high. They were using short money, meaning 2 to 3 years financing. And 3 years ago, the money was a hell of a lot cheaper than it is now. And when they looked at the projections of when they were going to exit, they put the same 2% cap rate in, 5 years out. And I just looked at this and I said, look, I know you guys love this. I know you're emotionally attached to this, but if it were me, I would not invest in it. And I wouldn't for these reasons. And I actually showed them what the numbers were and why it's so important to be able to dissect a PPM. It's critical because unfortunately the people who subscribe to that have probably lost a lot of money. And down in Texas now, there was a big case of, one of these students of a guru, went out, bought 3,600 doors, I believe it was. They bought it on short money, and it was another example where the cap rate was way too compressed, and they thought that they were going to, improve it and still, be able to get that super tight cap rate, and they wound up having to turn all 3,600 units into the bank. And it was devastating for the investors that invested in this.
Imagine.
Right, because it was just this feeding frenzy of, oh my God, it's Fat City, so let's just do it. And that's just not the way it works.
Well, we've had, same clients that I was talking about today, they bought some stuff in the height of, cap rates being low, interest rates being low, and, now interest rates flipped on them. And, you can't sell a 4% cap rate in an 8% interest rate environment. It's just.
No, well, if you have to put debt on a property and you're buying at a 4 cap and the interest rate is at 8 cap, you're already at a negative 4% just on debt alone.
Right.
Your cap rate has to be less than your interest rate in any market, good, bad, or otherwise, unless you're, independently wealthy and can pay cash on stuff. And, then there's other reasons why you would or wouldn't do it. But yeah, it's especially on short money when, people got, 2, 3, 4, 5 year loans. And, the ones that are maturing now are the ones that are about 3 years old. And if they had short money and cheap money, they can't refinance it now when their numbers were reflecting a 2% cap rate and they have to pay 8% for interest. They just can't do it. The numbers don't cash flow anymore. And that's why they have to sell, and they have to sell at a reduced rate quickly so that they don't lose everything, or they just have to give the keys to the bank, and it sucks. But if people don't understand the fundamentals of evaluating a property, a commercial property, the right way, they're gonna lose their bacon.
Makes sense. Well, we appreciate you spending the time with us this evening. I definitely appreciate you, giving back to everybody. So if everybody has any questions, we'll definitely reach out, but I'll touch base soon.
Well, thank you. It was my pleasure. Thank you guys for listening to me yap on, and I wish you the very best of everything. I'm going to turn the host back over to you.
Good. I'll just exit out of here if you want. So.
Okay. Yeah, I don't know if you have to stop recording or whatever, but I'm going to jump off and let you guys just chat amongst yourselves.
Okay. Thanks, Robynne.
Bye,
See ya.
guys. Thank you.